Today I'm going to go over a live example of the Navigator. Here I have my Claude instance opened with the Navigator, and I have my chart integration with the price map levels, time frame structure, and time phase. The market's just retested the directional. It's back pressing the open range midpoint. Is this momentum going to follow through? We are in a sell UP fade. So is this momentum going to continue? The market's trying to make a decision here. Do we want to jump on this train, or do we want to just leave it alone? Let's ask the Navigator. What are your thoughts on the 10-year? I'm also going to give it its last price, just so to make sure it's got the current last price. To have last price for futures, you'll need to have it connected to your broker or data feed. For crypto, it's live data. Okay, so Navigator's identifying the sell UP fade, which is this, selling the UP fade. And it's telling us that that sell UP fade is targeting the DP, which is down here. So we're in a sell UP fade, targeting here. Bias is lower. It's a supported bias. We're below the opening range midpoint. We do have overhead at 108.22. That would be the structure breaking point. Basically it's telling us don't press it at the opening range midpoint. Rather sell a bounce into 108.22 if we get it, or sell lower, not in the middle. So we're, the monthly structures with the negative momentum, let it come to the level. So tomorrow's FOMC, how should we adjust or hedge a negative sell UP fade position going into it? So let's ask the Navigator how we should position for the FOMC meeting. My expectation is that once the meeting minutes are cleared, we will have clear direction for the balance of the month. So the Navigator comes out, identifies the tension. You were shortened to a potential binary event. Basically meaning the play is to survive the gap, not predict it. 3 ways to handle it. We can trim, don't flatten. Basically monthly structures in our favor. So stick with it. We do have potential for a squeeze. Define the risk with a level, not a stop. So if we have a hard stop, above 108.22, it's going to invalidate, but we could gap through that on the FOMC. So if we are looking to keep the position in the gap, the next level up, basically above here, which would give back all of our profits, it's not really an option. So we really potentially looking to hedge. If we're either going to have to accept that risk, lighten up enough that we can accept that risk, or we can implement an option strategy. And it's going to be a short-term option strategy, looking to buy some calls, short-dated calls. So honest read, bottom line, basically trim into the event and add a defined call spread hedge over flattening. We are looking for 107.08 as our target. Here's our risk. Even if we're on the market there during the minutes, it could be a gap event. So it's always good to have some protection. So based off the price map structure, the 108.24 calls are right on our point. So that is kind of the perfect hedge. What are those going to cost? Depending on that, we know we're really not wrong unless the market goes above here. So we could spend a little less and buy some of the 109 calls or even the 108s. So the navigator comes back and says, hey, I only have access to deribit options data for crypto. I don't have any options data for the 10-year. So I'm not going to make up any numbers, but here's what we can do. So it's telling me, go pull the options data. What we can do is we can structure the hedge around your levels so you know exactly what to buy. So I'm going to give the navigator a little help. It's my assistant. We're working together. We're trying to figure it out. It's going to tell me what it can and can't do. It doesn't have access to options data, so I'm going to let it know that the 10-year options trade in quarter points. So 108.24, 109 even, 109.08 are the strikes to look at for this construction. And what do you recommend and what duration? And then I'll check the prices. So that's coming back to me with the strike selection. It's by the 109 even calls. This is the discredit line because we're going to be through the CR plus. So the market's already going to discount this negative momentum. So then it is actually just, it's either a retest and a fallback into neutral, but it's definitely kind of shifting the lean back to possibly positive. If we're going into the 108.25 strike, it sits right at the line. It's too close, and we're going to pay too much premium for covering in that noise. We're already watching the 109 calls. This is a call spread, so it's recommending sell the quarter strike. So sell the 108s. Basically, once we're through 108, we're wrong, and the whole position needs to be reassessed anyways. So this is just kind of adding a little bit of a buffer for the insurance there. We want to buy short expiry just to clear the FOMC minutes. So either the serial weeklies. We're just covering the event gap. Our expectation is that's going to point the way. It's going to cost less. It's going to cover the window we're worried about. I'm going to drop some prices in. So the navigator with the prices, it says, basically what I was recommending before didn't make any sense. And I'm going to correct my read. So with the real pricing, the navigator is going to process this and refine its recommendation, and it identifies that its original spread that it was looking at is worthless to own. It's looking to put spreads on because it's going to reduce the cost of just owning calls outright. But as it goes through its recommendation, it realizes that, putting on a call spread doesn't make a lot of sense. We're not really helping ourselves that much by adding that sell component. It's actually hurting us. And so the cleaner recommendation is just to go long the 108.24 calls with no short leg. It's also just saying you could just trim your size. Basically recommendations, the spread doesn't pay here. Either buy the 108.24 call outright for clean uncapped gap insurance through your discredit line, or trim the short and let the low price option tell you the squeeze is unlikely. The low option prices are telling us that the squeeze is unlikely. And it's saying I'd lean into buying the 108.24 calls if you want to hold full short size. But based on our expectation, the market is showing it's not trending. So it would be odd to have this thing gap and scale. And it's more likely, if it does take out and break structure here, it's going to stall out here. So it doesn't mean that the market's going to break out above here and scale. What's more likely, it's probing higher and falling back into neutral, especially with the end of August here. So we're not going to want to hold on to these calls very long. As soon as the event's over, we're going to want to get out of them. Or if we're paying for the insurance, we want to pay less insurance and just say, you know what, we don't expect the market to go higher, but you're not valuing those 109 even calls at all. So do we just want to add those up as just a backup low insurance? Well, let's ask Navigator that. Since the 109 even calls are cheaper and we're protecting against an upside event, as our expectation is that the 108.24 level is taken out, it just reduces the likelihood that the sell UP fade will follow through. It doesn't make an asymmetrical event more likely. So our expectation is either the 109.02.5 upside pivot is going to hold, and if it doesn't, then we could see that event. So we're more looking for a stall after the 108.24 versus an event. So we're basically just talking to the navigator through this trade and what we want to do, and it's working with us. That's the whole point. Like anything else, as we get more clarity, we refine our expectations, and here, the Navigator is just zeroing in and identifying that, yeah, you know what, the 109 call is the way to go. And it's inexpensive. So here the Navigator comes back with, yeah, we're aligned. Logic's exactly right. The expectation is if we take out a 24, it's going to run into a wall here. And if it doesn't, that's the risk because it can scale up to here. So that's what we want to protect. So we want to focus on the one or even calls outright. They're cheap. It's inexpensive insurance. We're not doing the spread. We're not doing the 108.24 calls. They're too expensive. So the 109 calls are the hedge. Into an event like FOMC, the job is not to guess. The job is to know the exposure, know the structure, and decide what risk you're willing to carry. Navigator helps frame that decision. It doesn't replace it. The trader remains the operator. This is part of the TradeVision series by Market Trade. Market truth before execution. Enjoy your day.